Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Hindustan Motors all charged up for a big bang return. Years after being driven off the roads by Maruti, the company, which made ambassador cars, now signs an MOU to manufacture electric vehicles. Markets end flat as traders to sell towards the end of the session prefer to stay low ahead of expiry tomorrow. Sensex up 92 points, Nifty up just 23 points today. Global brokerages place their bets on the Indian markets. Goldman Sachs says Nifty to rise by 10% to hit 20,500 by next year end. CLSA goes a step ahead, says Nifty will hit 21,850. Business Today TV, an exclusive conversation with Saurav Mukherjee of Marcellus, says he does not expect tech startups to do better anytime soon, shares his mantras for successful investments. Hindustan Motors planning a big return to Indian roads in a modern electric avatar. The CK Birla Group company has signed a memorandum of understanding to implement its plans. For the 80-year company, it will be a second coming after its sole product, the Ambassador, was edged off the roads by more nimble competitors.
Even millennials will struggle to remember it. Ambassador, the grand aim of Indian roads, which ruled the Indian auto market with an iron fist till the 1980s. It was a darling of the Indian ruling class, signifying ultimate power, peaking in power trips atop the Raisina Hill. For the Aam Aadmi, the Ambassador was an elusive beast. Based on the decades-old Morris Oxford, the car weighed more than a ton and was powered by a 1500cc engine, belting out measly 36 horses. But this did not stop it from being the ultimate object of desire, with waitlist running into years. In this tiny car, the Maruti 800 was born in 1983. The Japanese hatchback slowly but steadily edged out the Ambassador, relegating it to history books by 2014. The Ambassador brand is now owned by Peugeot, which bought it for 80 crore rupees in 2017. Hindustan Motors, meanwhile, is intent on a comeback in an electric avatar. The company's share price shot up 10% in trade today, hitting upper circuit on news that it has signed an MOU to enhance production of electric vehicles. Little is known about the deal, but it has been enough to enthuse Dalal Street.
EV vehicle is the new theme for the automobile sector, and the kind of announcement as you are discussing about this Hindustan Motor, it's really going to a game changer for the company. And looking at the price action in today's session, stock is now upper reach. But looking at the overall setup, it's almost 15-week breakout on the weekly chart. And looking at the price action, we believe that if it continues to hold above 17 rupees 50 paisa, then possibly next target for stock would be around 22 to 24 on the higher side.
The required infrastructure to make the new electric vehicles is already in place. The company still owns the Uttarpara plant near Kolkata, though its size has shrunk to 295 acres from 700 acres. Rest of the land has been sold to Shriram Properties and Hiranandani Group for commercial developments. The company also has around 300 employees on its rolls, and despite accumulative losses of around 150 crore rupees as of 31st March 2022, Hindustan Motors is largely debt-free. According to reports, the new EV project could entail an initial investment of 300 to 400 crore rupees money, which Hindustan Motors apparently has from its land deals. Bureau Report, Business Today Television.
Bengaluru-based EV startup Praveg Dynamics is all set to introduce its first electric car T5 e-SUV, a range of more than 500 kilometers on a single charge, potentially slots it with the likes of Tesla. The company claims the battery can be charged to 80% in just 30 minutes.
What we have here on our hands is actually an exceptional vehicle. I mean, the all-new Defy, the car is called Defy. So the all-new Defy is essentially, it's automotive reimagined. It's reimagined to be exceptionally performant, amazingly featured, and it's surprisingly rugged, which is a key requirement for India, you know, and a lot of other nations actually in the world. So you got to meet the most sustainable and privacy-respecting vehicle ever. It's got 500 kilometers of range. It goes 0 to 100 kmph in 4.9 seconds. It's got 5-star safety. So what Defy does really is deliver a fantastic way to move, work and relax, all three things, since we spend so much of our time on the road, essentially.
Indices ended flat today after remaining in the green for most of the day. With November expiry looming tomorrow, traders prefer to stay low. Bank and media indices climbed the most, with PSU banks jumping 1%. Metal and IT ended in the red, while FMCG also struggled but ended flat. The Sensex ended 92 points higher at 61,511, while the Nifty was up 23 points at 18,267. Top gainers today: Apollo Hospital, HDFC Life, JSW Steel, Bajaj Finance and State Bank of India. On the losers list, Adani Enterprise, Adani Ports, Hero Motors, Power Grid and Tech Mahindra. The laggards led there by a couple of those Adani Group names. It's a typical I told you so story. Analysts who were drowned out in the euphoria of new age tech IPOs are having their voices heard again. One such voice is Saurabh Mukherjee of Marcellus Investment Managers, who had warned investors against investing in companies without a positive cash flow. Business Today TV's Rachna Dhanrajani caught up with Saurabh. Listen in.
Never quite understood why people spend so much time thinking about the level of the stock market. To the extent you have a country where the economy is growing 6-7% at real terms, corporate earnings are growing 15 to 20%. Naturally, the stock market will oscillate up over. The stock market will grind up over time. The issue is not whether equities will hit fresh highs. They will hit fresh highs repeatedly in your and my lifetime. The question is, can you and I and your viewers, can they make money consistently from investing in the Indian market? The Marcellus proposition has been, yes, you can make money consistently in the Indian market if you invest in companies which are clean, well managed and have dominant franchises. So distinct from whether the market will go up, yes it will. Distinct from that is the question, can you consistently compound? Our proposition is yes you can, and that's something which we've written about in our books, whether it be Diamonds in the Dust or Coffee Can Investing.
We see this trend that the startups that we 1 year ago saw get listed on the BSE or the NSE, and now where the lock-ins have ended, the valuations have dropped. What do you have to say about that?
Nothing new here, right? Every decade, the Indian stock market finds a new paradigm to get worked up about, and then the paradigm crumbles in less than a couple of years. We saw this same story play out with power and infrastructure, and the movie's replaying this time with tech-enabled stories. If a company doesn't generate cash flow, if a company has never generated cash flow, it's unlikely that it will generate cash flow after you buy, right? So everybody cites companies like Amazon, and on the back of the one spectacular Amazon, a lot of other low-quality companies have floated. But there's only so much lipstick you can put on a pig. And I think our stock market has probably done that in a little bit of excess. Yes, there'll be successful tech-enabled companies in our country, but out of every 10 aspirants, 1 will succeed, the other 9 will destroy your wealth. And therefore, again, I go back to the same proposition. Look for companies cleanly managed, competently run, dominant franchises, and the dominance manifesting itself in superior cash flows coming out of the company. Very few tech-enabled companies have done that, unfortunately.
2020 was a year where Indian markets outperformed its global peers. Do you see this momentum sustaining, or where do you see we're headed now?
So as I just said in the presentation to PMS Bazaar, right, our point of view is that what we are going through is very similar to America in its heyday, 1880 to 1930. We're joining the country up, not just physically joining it up, financially joined up, digitally joined up, tax evasion is being cracked down upon, we are formalizing the economy, cost of capital is coming down. This confluence of factors is very, very powerful. Very few large economies can hit so many buttons at the same time. Given that the rest of the world doesn't seem to have anything remotely comparable, my reckoning is for several years to come now, India will be the world's fastest growing large economy.
You said while investing, we must have 3 categories where we should judge the company by. It should be clean, it should be clear. If you could expand on that, and which are these companies that you see in the current time?
Right, so the cleanliness aspect is the account should be clean, the promoter shouldn't be stealing from the company's books, right? Self-evident, if you give your money to a crook, you ain't going to see your money ever again. Secondly, you need to see a track record that the promoter, the management team actually is competent. And the simplest way to assess that is look for companies where return on capital exceeds the cost of capital over long periods of time. There are actually very few companies in India which meet these first 2 criteria. If you ask me, in my 14 years in the country, I've seen no more than 60 companies who meet this double criteria. In addition, to compound your wealth over and above cleanliness and good management, you're looking for dominance. The simplest way to understand dominance is you're looking for companies who charge their customers 20, 30, 40% higher than what the competition charges, and yet not a single customer walks away, right? So if you get these 3 ducks lined up, clean, competent, dominant franchise, it is relatively hard not to make money, provided you're a patient investor.
What do you think one should do in this entirely new age tech space where the doors for selling have just opened up?
As I said, if a company doesn't make cash flow, it's not really a business that I can invest in. So difficult to sell something that we haven't bought, and you know, I simply can't get my head around how people buy companies which don't generate cash flow. To be fair to investors in tech, this is a standard challenge in Indian markets. Even in sectors like power and infrastructure, broadly in the Indian stock market, free cash flow generation is very scarce, right? If you take the BSE 500, there'll be barely 60 companies which generate cash with any frequency.
It's not only Nykaa, but share of several new age digital companies like Paytm, Delivery and Zomato are in focus after their lock-in period ended this month. Ever since the lock-in expiry, investors have been diluting their stake in these counters. Where are these stocks headed and what should investors really do? My colleague Tanya Aneja spoke to Divam Sharma of Green Portfolio. Listen in.
So Divam, SoftBank sold 29 million shares of Paytm through a block deal. Lighthouse India has been selling Nykaa shares of late, and shares of Zomato also took a beating after the company's founder, Mohit Gupta, resigned from the company. So help us understand what's really happening in these counters and where are these stocks headed and what should investors do at this point in time?
So as we all know that these type of companies came to the Indian IPO markets in 2021. And the markets had not seen these type of companies ever before, right? In US, we still have examples where there are a lot of such type of companies who are there, who are non-profitable, are growing fast, and the markets are aware of the operations of these type of companies. When you come from a private equity background who has a primary target of growing the company to as much as possible, and to an environment which is an post-IPO environment where there are retail investors, where there are a different set of investors who target profitability, who target valuations. It's a different ball game altogether, right? Okay. So the idea here is that these companies, the PE investors who were early investors, they saw this type of a growth. Now, a lot of these investors like SoftBank is having some issues in their own fund. They are targeting like cash generation from selling off their different investments. Now, the mandate has also changed over the period that 2021 was a very high liquidity period. And now it's a period where the investment funds, not only the post-IPO investment funds, but also the pre-IPO investment funds are targeting profitability and matching it with growth. So the DNA changes for these companies all of a sudden, right? Now, earlier you were targeting growth only. Now you have to target growth along with profitability and sustainability of the business. So that is having a beating on the stock prices now.
The industry is not only seeking a cut in income tax rates in the coming budget, but also rationalization in the much reviled securities transaction tax. This comes on the heels of an earlier Business Today TV report that the government is having a relook at the capital gains tax. Business Today managing editor Siddharth Zarabi spoke with renowned chartered accountant Vivek Jain for more on this.
I'd say to simplify it in the best possible way. One my proposal will be that less than 2 years is a short term and beyond 2 years is a long term. That's so simple. We don't make any distinction between any asset, movable, immovable. We simply say if you have held the capital asset for a period of more than 2 years, then it is long term, and then it was a short term. So simple, the formula should be clear on that part. And in case it is a long term, then the tax rate will be two rates. One, productive and non-productive. If it is a productive investment, then 10%. If it is non-productive, then it is 20%. That's a flat rate. And for a short term, no concession, straight away 30%. That's the rate should be there. I believe ideally that can be the best model for the taxing the capital gain, what we think about it. Because short term, by and large, is not really a capital gain. You make money by churning out. That's why it should be flat rate of 30%. There's no reason why concession rate should be applied to capital gain, short-term capital gain.
I want you to quickly explain one point. In terms of the rates, at this stage, do you see the need to increase the rates or unify them and moderate them?
See, idea is, I believe, to simplify and to remove complexity in the capital gain tax structure, rate of capital gain. I don't think that's the idea. And that, I think that in the way back, I think 2018, we have already done that exercise where we have taxed the now capital gain arising on the listed share. I don't think the objective at present looks to be to increase revenue. What can be an idea? Indian model has to be different than the advanced country. We must keep this in mind, developed nation, because US and Europe follows a different model, and they do not allow you, if you to carry over the increase in value as we do in India. If you have sold one asset and you have invested in a new asset, the capital gain gets fully exempt. That we have not followed the model in US and Europe in that way. Because India still being a developing nation, we need a large chunk of investment.
Okay.
And if it's a large chunk of investment, not only from FDI, FII, but from the Indian investors, small saving investors. So we need to encourage people to come more and more to the capital market. So we cannot follow that model of developed nation. That's why I said that in case it is more than 2 years, let's have a concession rate of tax, and that encourage people to invest more and more in India. That's the idea basically.
With the India-Australia Free Trade Agreement in the bag after ratification by the Oz Parliament, all eyes are now on the free trade deal with the United Kingdom. The deal was to have been signed before Diwali, but political instability in the UK prevented it from happening. Kevin McCall of the UK-India Business Council spoke to Business Today TV about the road ahead.
What is the latest update when it comes to the trade agreements? Now, we're being told that there are going to be meetings lined up next month. What are you picking up?
Yeah, no, that's absolutely right. As you said, the two Prime Ministers met in Bali last week, and they've reaffirmed their commitment to doing a deal. I think the negotiators are working, urgently towards a conclusion. And I think it's fair to say that there was a lot of noise around Diwali time. There was expectations that a deal would be done by Diwali. But I think if we take a step back, what the government's actually agreed to do back in April was to complete the majority of the talks by the end of October, which they've done. So 14 of the 26 chapters have been provisionally closed, and now the negotiators are continuing to work at pace to try and close off some of the stickier points that are there in the negotiations. So hopefully with the urgency and the pace that's in the discussions, we will see a deal emerge that's both comprehensive in terms of sectors, so goods and services, and doesn't take us too far into the future in terms of the deadline. We want to see something happening in the near term, but we don't want to rush something just for the sake of speed. We want to take our time and get a deal that's comprehensive.
Okay. Kevin, you did talk about deadline, which we'll come to later, but what was this delay about? Was it an administrative delay, or was it because of course, the political developments in the UK?
I don't actually think there was a delay. As I said, the joint statement from both governments when the PMs met in April was to aim to complete the majority of the talks by the end of October, which they actually have done.
But we were looking at a signing ceremony close to Diwali.
That was never formally stated by the governments. The aim was to complete the majority of the talks by Diwali, which they did. And I think, as you rightly indicate, there's been changes in Prime Minister in the UK, and some turmoil since sort of June, July time. But for the negotiations themselves, I don't think that actually impacted the negotiating teams, because back in January they were given a mandate by the cabinets from both countries. So the negotiators continue to work to that mandate. And it's only as we approach this period now where we're bumping up against the edges of the mandates, that's when the politicians have to re-engage and to try and do some of the political negotiating that will help us to land a deal. So I don't think the changes in the Prime Ministers in the UK over the last 6 months have actually derailed or slowed down the negotiations at all. But it is now the point, perhaps after the next round of negotiations in December, that's, I think, when politicians may have to get more engaged in the process.
The Dholera Special Investment Region in the Ahmedabad district of Gujarat had few takers in the last few years, but the recent announcement of a greenfield airport has investment activity suddenly picking up. Even as Gujarat goes through the election grind, Business Today TV's Chetan Bhutani brings you this conversation with Pathik Patwari, President of Gujarat Chambers of Commerce and Industry.
Dholera is now poised for the right position. I think, of course, it had to be active much earlier, but somehow it got delayed, and then it was struck by COVID. So we lost good 2-3 years out of that. But now with the announcement of the semicon production facility that might come up in Dholera, and coupled with the construction of the new international airport that is coming up there, we are definitely positive that the entire industrial ecosystem in and around Dholera sounds very promising. We have a 6-road connectivity that is coming up between city of Ahmedabad and Dholera. So if these things what are talked about are actually going to happen, this is going to change the scenario the entire Dholera has been. Of course, we do not deny that it was dead for a couple of years. But I think the traction which has now gained with the investments coming, Tata Power is already there. We have RE Industries which have established their production line. And soon we'll be seeing the semicon production facility coming up there. So I think, yes, Dholera, we are very hopeful that in the coming days it will be a destination like what Sanand has now become for the automobile industry, or Vitlapur, matter of fact. Similarly, for the next gen industry, it is Dholera that is going to be the destination.
But there were issues about, a lot of corporates raised issues about the cotton soil, that's the problem there. So you cannot change the soil, yes, but you can change the location. So will Dholera be Dholera, or probably it could be shifted to another place, or the whole infrastructure idea could probably go to another place? Is there any kind of talking on like that front?
I think the strategic position with Dholera currently holds, because Ahmedabad being the industrial capital or the finance capital of the state, any proximity and the development, if it has to happen, it has to happen around Ahmedabad. And Dholera is the area where you have sufficient land available as on date. So we don't see any other option other than Dholera right now where the development could happen. Sanand is now getting quite saturated. Same is with Vitlapur and Mandal, where the automobile industries have come up. So according to this, we believe that Dholera is well positioned now. The development will happen. It will be slow. Talking about the black cotton soil, what you say, it does definitely, that is increasing the construction cost there. But I think the industry which are coming up there and the kind of incentives the state government is offering on the land prices, we see a win-win situation for both the state and the industries to come up in Dholera.
Pathikji, I want to ask you about how Gujarat can probably become the next destination after Maharashtra for industries, because there have been really various talks about how Gujarat is poised to develop as an industrial hub, and because Maharashtra has some saturation problems, some water problems, which Gujarat really doesn't have. So what's your opinion on that, and when do you see that happening, of industry destination being preferred to Gujarat over Maharashtra?
There has been a lot of political tug and war and a lot of shouts around the various projects which have recently come to Gujarat. And in this name throwing game, we have forgot the inherent strength the Gujarat has always had, and upper edge which we always had. Couple of years back, when Tata Motors moved from Singrauli to Sanand, people thought that this is something which is out of the box. You should have not done that. So much offers to a corporate should not have been made. Today we see the results of one strategic move by the then CM and now the Honorable Prime Minister of the country, Narendra Bhai Modi ji, that he made sure that he attracted one and then many followed. So that's the way the businesses work.
That's where we leave it on the show tonight. Thanks so much for watching.